We want to ensure that every veteran across America, anybody who's eligible for their VA loan, can have access to the full scope of what the VA offers them as a home loan benefit.
The big deal here, zero down. That's why 80% of the people use VA. And some of them use zero down because they have to, and some of them use zero down because they want to. The other parts here, no mortgage insurance, no PMI. Do any clients want PMI? No. So it doesn't have any. We'll talk about how it compares to FHA in a second, but this is a big deal. It's one loan, so no 80-20 programs. Believe it or not, there are adjustable options. There's a 3-year adjustable and a 5-year adjustable. We hardly ever use those. The fixed options are 15 years and 30 years. 99.9% of our clients do 30-year fixed loans. Plain, boring, vanilla, principal and interest 30-year fixed loan, because quite frankly, that's what clients want these days as well, is a nice, safe, secure house I can afford. There's no prepayment penalties, and VA loans typically are lower rates. What do I mean by lower rates? I mean somebody that's getting a VA purchase with zero down, that maybe even has marginal credit, is going to get a better interest rate than somebody doing 20% down that has an 800 credit score. Yes. Why is that? Because it's a government-backed loan and the banks have less risk. So we'll typically see VA rates running about 0.25% less than a conventional interest rate. That will come up a little bit later on, one of the places that the VA really makes sense, because who here has a client that wants the lowest interest rate possible? They all do. Justifiably. So if you can get the lowest interest rate possible, you probably want to take advantage of it. The VA loan is assumable. Is this a big deal right now? No. Is this going to be a big deal in the future? Yes. Why? What do I mean by assumable? I mean anybody, military or not, who is creditworthy can assume your VA loan in the future. So your client goes out and buys a $400,000 property. Currently, let's guess it's at 4% interest rate. 5 years from now, let's assume that the market's done nothing. House is still worth $400,000. Your client goes to sell his house for $400,000 and the neighbor who has a regular loan goes to sell his matching house for $400,000. Interest rates 5 years from now, give me a number. What should we use? 7, 8. Let's use 7. I think it's 8 more right. Interest rates are at 7%, so the buyer comes along and says, okay, I got these 2 houses to choose from. They're both $400,000. They both look exactly the same. I can go get the same loan on both of these. I wonder which one I want to buy. And your veteran buyer seller goes, hey, you can assume my 4% loan, which has already got 5 years taken off of it, and buy my house. And would you rather do that? Is that a valuable commodity? Could your seller say, hey, you know what, I'm not going to sell for $400,000. I can sell to you for $450,000, and it's still a cheaper deal than you buying the neighbor's house at $400,000. Do you want to buy my place? That's where this is going to become important in the future. So interest rates are ridiculous right now, and assumability at some point in the future, we'll probably see we'll see a lot more of it. So right now, you know, I can get an interest rate of 4%. You're at 5%. Well, I'll just get a new loan. But when rates go up, this is where this will become a big deal.